Namaste, welcome to Arthneeti, where we discuss money and money related tools to help you in your everyday investing decisions. I am Dr. Shifalika Gokhale. I hold a PhD in business practices of mutual fund houses. Today's video is done as an investor awareness program for Samyak FinServe. Now, see, stock markets may be as exciting as a fast paced sprint, but fixed income instruments are your marathon for steady returns, especially now when the FD rates are at an all time high. It's time to lock in those gains. In the Indian investment landscape, the attraction of high returns that the stock markets have to offer is undeniable. But fixed income instruments, which are often ignored, offer stability and attractive yields, making them a compelling option for many investors. It is crucial to remember that a well rounded, diversified portfolio is the key to long term wealth creation. In this video, let us explore why fixed income instruments in India might be particularly attractive right now. Today, SBI, the biggest, largest bank in the country, announced a 75 basis point increase in its FD rates for the period less than 1 year. In a function that Nirmala Sitaraman, our finance minister, was attending in Bombay Stock Exchange, she said that unchecked explosion of retail future and options trading will dent household finances. People need to be aware and take precautions of not losing money into unchecked trading in future and options to earn quick money, right? One interview that I was seeing today of the chief investment officer of UTI Mutual Fund, he spoke about three golden rules of investing, which I thought were very pertinent and all of us should follow in our investment journey. He spoke of diversification, spreading our investments across various types of investment instruments. Second, he spoke about a long term outlook, means giving your investment time, right? And third, and the most important part that he spoke is do not leverage. Focus on your profession or job from which you are earning money, then save that money. And the third thing to do is investing. So you do not take money on interest or on loan and then invest it in high risk trading instruments like future and options. Now these three uh, golden rules, I think all of us should by heart and imbibe in our investment journey, right? So the focus on today's video is this the right time to invest in fixed income instruments in India? Yes, I told you SBI increased its interest rates by 75 basis points today, correct? In this video we will focus on these following points. The first one being interest rates and attractive yields in the current scenario. Secondly, inflation and real returns. How does inflation affect your returns? Third, potential of falling interest rates and capital gains. Fifth, the fixed income of portfolio diversification and risk reduction. Then, impact of global economic conditions. And we will end the video by looking into the various fixed income investment options available in the country. When the RBI increases the repo rate, it has a corresponding effect on the deposit rates offered by the banks. So, when the repo rate goes up, the FD interest rate also goes up, and vice versa. Like when the repo rate decreases, the FD interest rate starts going down. Correct? Now, in the last MPC, Monetary Policy Committee meeting held by the RBI, it had kept the repo rate unchanged at 6.5%. This has been the case since April 2023. So the repo rates have been kept steady for almost a year now. Many known brokerage houses like Goldman Sachs, Morgan Stanley have estimated that RBI will not decrease the repo rate in the first half of this fiscal year. So there is still some time before the RBI starts the rate reduction cycle. Because of the steady rates that the RBI has kept, interest rates offered on fixed income instruments is also steady and at a relatively higher position right now, given the RBI stance. While deciding on an investment option, it is important to take into consideration the real rate of return. Now, what is the real rate of return? Well, it is the rate that you earn above or after adjusting for inflation. Now, the April figure for inflation stood at 4.83%, which was at an 11-month low. Now, suppose your fixed income investment is giving you a post tax return of say 7%, it is still a clear 2.15% of real return that you are investing, that you are earning on your investment. So checking the real return is very, very important. As I previously told you, as per major brokerage houses, the expectation of the rate cut cycle to begin is from the second half of this fiscal year. Now, once the rate starts decreasing, it has a significant impact on the bond prices. Once the rate once the rates are reduced, the bond prices tend to go up. Now, by investing in fixed income instruments now, what you can do is you can lock in the high yields given the good rate of interests that are prevalent right now, and benefit from capital appreciation when the interest rates go down. Why? Because your bond prices will tend to go up. One factor not to be overlooked here is the taxation angle. See, taxation needs to be considered for the interest as well as capital gains from your bond investment. Now, the interest that you earn on bonds is added to your gross income and taxed at your applicable tax slab. Where, when it comes to capital gains, you can bifurcate the bonds between listed and unlisted bonds. Now, for listed bonds, capital gains are applicable if you sell the bonds before 1 year, within 1 year of purchasing it uh, at a gain. Then that gain will attract short term capital gains at a tax slab applicable to you. For any sale that you do beyond 1 year for listed bonds, long term capital gains tax at 10% without indexation is applicable. Now, coming to unlisted bonds, the period is 3 years. If you sell the bonds before 3 years, then short term capital gains tax at your applicable tax rate is levied. And if you sell the bonds after 3 years, long term capital gains tax at 20% without indexation is levied. So, this taxation angle should not be overlooked. You can as well invest in government and PSU bonds, which are tax free and are raised by the government to fund important projects. Now, diversification is one of the important golden rules which you should implement in your investing journey. Not investing in a particular share or a particular mutual fund is going to serve you build a healthy portfolio. What you need is a mix of investments in your investment portfolio. When the markets are jittery and not performing well as they are currently, fixed income instruments, if they are part of your portfolio, give you that stability and steady rate of return which is needed in times of downturn in the market. So fixed income instruments help you in achieving diversification in your investment portfolio. See, when it comes to investing, global economic factors also have an impact on our investing decisions. They cannot be overlooked. We cannot invest in a bubble, right? So, global economic factors like, say, US Federal Reserve, where it is also taking a stable stance by not reducing the interest rates. But yesterday, the inflation data, which was published in the US, shows that the inflation has cooled off from a 4-month high cycle. Now, if this continues, US Federal Reserve will start their rate reduction cycle sooner than later. If that happens, what effect will it have on the Indian market? See, when the US Federal Reserve starts reducing rates, money will flow to other economies, emerging economies in the world, where the possibility of earning better return rises. When the rates are high in the US itself, why wouldn't people take advantage of those high rates rather than taking out money from the US economy and investing it elsewhere? Correct. So once the rate starts decreasing in the US, money will start flowing out of that economy into emerging economies like India. So right now, the interest rates, the bank rates of the US Federal Reserve are steady. But if inflation keeps on cooling the way yesterday's numbers show, there is a possibility that US Federal Reserve will start reducing the rate sooner. Second important point which we need to consider is the inclusion of Indian bonds in the JP Morgan Emerging Market Index. Now, this is going to happen beginning of June. Now, once that happens, this particular index will have a 10% weightage for Indian bonds. What will happen is, once this starts happening, there will be increased inflow of foreign funds into the Indian bond market. Ever since this news was announced last year, $8 billion have been invested in the Indian bond market from foreign countries. Now, once June comes and the inclusion actually takes place, it is going to see a significant rise in the money that flows into the country. The liquidity that particular inclusion will bring is going to be tremendous. So bonds in India will be more attractive, will be open for investments from outside the world and not limited to investments in the domestic space itself. Correct. So this is one important news which we cannot overlook. See, what happens is, when the bonds start to become more attractive, the inflow of money tends to rise. The It is a what can we say, it is a demand and supply game. When the demand starts rising, the prices also starts becoming attractive. Again, a gain in sight for investors who have taken advantage by investing in bonds at the right time. Coming to the fag end of this commentary, what are the types of fixed income instruments that you can invest in? The first one will be corporate bonds. The second one will be government bonds. Now, where government bonds are considered the safest because of the sovereign guarantee of the governments, corporate bonds are typically, they offer higher yield than government bonds, but also have a higher degree of risk as compared to government bonds. Next comes fixed deposits offered by banks and corporates. And the next option is debt funds, where mutual funds have to invest in a variety of fixed income instruments, offering diversification and professional management. So when it comes to debt funds, not less than 65% of the assets under management need to be invested in fixed income instruments. So these are the four options that you can think of if you want to invest in fixed income securities. Now, before taking the decision of investing, what you need to consider is your time horizon. For how long do you want to invest that money? Do you want that money for a specific purpose after a specific period of time? Think about these things. Correct your risk tolerance. What is your risk tolerance level? Think about that. And lastly, not to be ignored, the tax implications of your investments. The safest way to invest in the most suitable fixed income instrument is by taking an advice of a financial consultant or a financial advisor. Yeah, it is worth the time you spend with your advisor, so never overlook that part. um, I hope this video has been a value addition to you. And in case you have any questions about investing in such instruments, please feel free to comment below the video and I will be happy to help you. Please like, share, and